why should the three of us, because we're a partner and we spend 20 years, we can make a lot of money out of this when we leave, and someone who is on the administrative side, not going to reach the partner level, gets nothing when they leave.
Yeah.
Now they can get a lot of money as well.
If you'd like to earn CPE credit for listening to this episode, visit earmarkcpe.com. Download the app, take a short quiz, and get your CPE certificate. Continuing education has never been so easy. And now, on to the episode. Hello, everyone, and welcome back to the show. I'm Blake Oliver.
And I'm David Leary.
And we have the privilege today of talking with Wayne Berson, the Chief Executive Officer of BDO USA, one of the nation's leading accounting and advisory firms. He's also the chair of the Global Board of BDO International. Wayne has been with BDO for over 20 years, starting as a partner in 2001 and being elected CEO in 2012. Most recently, he led the firm's transition to an employee stock ownership structure, making BDO the first large public accounting firm to implement an ESOP. Wayne, welcome to the show.
Thanks very much, Blake and David. Looking forward to it.
So Wayne, Blake really just said it. You're the first major public accounting firm to roll out an employee stock ownership plan. So why now? Why was it now the right time to do this?
That's a good question. Yeah, we are the first large one to do it. There are a few others, smaller firms. But, at the end of the day, we were looking at what's good for our people. When I started as CEO in 2012, first thing we did was we put together a strategic plan. And that plan, which revolved all around people and helping people thrive. And people gets defined as the people at BDO, their families at home, our clients, and the community. Because we firmly believe you have to give back. You can't just take. So we embarked on a plan to grow. Over the next decade, we grew from $600 million in revenue to $3 billion in revenue, the largest increase of any firm in public accounting history. What's interesting about that growth is 61% is organic and only 39% is expansion growth or M&A growth. And a lot of people think, they did a lot of deals, which is true. We did 70 deals, 70 over the decade, and they thought we were just buying our growth. That's not true. Every deal we did was accretive. So as we moved forward and we became a bigger player, it was important for us to make sure we had enough people. When you look at the people situation in America, it's pretty dire. I mean, you guys have had a lot of discussion around this topic. There was a study done recently between the American Institute of CPAs and the Department of Labor. And what they concluded was there were about 44,000 firms in America. In order to have those 44,000 do their jobs, service their clients, they need 125,000 entry levels on an annual basis. So then you look at the typical output from the universities, and the business schools are graduating about 75,000. So you have a built-in shortfall of 50,000 this year, last year, year before, next year. So we said, okay, we needed to start looking at this as well. That led to us building a service center in India with BDO India. We went into a joint venture with them. And that's gone, in a matter of 4 years, we've gone from 0 to 2,500 people. Now, that's a sad thing in and of itself, that we're having to go outside of our country to get people to do the work. But we have the clients. We've got to provide service to these clients. So how do we get new people, let's say, all the way to the partner level? today's generation wants something different to when I was starting out in public accounting. They want to feel that they can touch something, that they contributed to building something. So if you look at our industry, the staff turnover, people leaving, is about 35% in our industry. BDO is about 17, 18%. And we're very happy with that number, which is still a bad number. There's 6,000 ESOPs in America. And the average turnover amongst those 6,000 is between 5 and 6%. So we said, we may be onto something here. And so then we started looking about it, what it is, how do you convert to become an ESOP? How does this all come together? We started in 1910, and we want to be here for another 113 plus years. And this helps us live, our core purpose. It helps contribute to the economic well-being of all our employees. No firm in history can say, in a few years, we'll be able to say, we gave away possibly $1 billion. No one else can say that. And it is mind-boggling when you think about it, but why should only a certain group of people win when there's an opportunity to have everyone win? So that's been the biggest thing for us, is trying to get there, trying to make sure that this is good for everyone. And the response has been amazing. Our people, I had people come up to me crying, people that would typically not rise to the level of a partner, more on the, let's say, the administrative side. They would work at BDO for 20 plus years, and then they'd leave. Now they're going to leave with, in effect, a pension, whereas before there was no such thing for them. Some of these folks came, as I said, they were crying. And it really is good to see how we've been able to help people. Now, obviously, the proof will be in the pudding. But it's interesting that if you look at some of the large grocery chains, Publix, Wawa, they both ESOPs. I think they're the two largest ESOPs in the country, and then it may be us. And when we unveiled this to our partners and we started talking about it and the whole notion of where we wanted to go, one of my partners said his father was a butcher at one of those two grocery chains, and he worked there for about 40 years, and he retired never having earned more than $40,000. When he retired, he got a check for, I believe it was about $1.5 million.
Amazing.
Yeah.
It's amazing. It's unheard of. So I think, for us, it's good. Now, obviously, we have to perform in order to make this a winner, or everyone's going to criticize us. But we're off to the races.
So if I could summarize before Blake jumps in with some more questions, I think make sure what you've told us is BDO was innovative, they grew. But in order to keep growing the way you've been growing, you started to realize you can't do that with 35% employee turnover. You have to figure out how to stop this arguably bleeding. And so you recognized having the ESOP, you might be able to get the bleeding down to 5%. And now BDO can continue to grow. Am I summarizing that correctly?
Absolutely. 100%.
So you borrowed over $1 billion to make this happen. I take it that money is going to buy out the partners so that you now have equity to allocate to the employees. Is that what that money is for?
We don't get into all the terms of our transaction typically, but I do want to make it clear it's not a private equity deal. The first report that came in the media, by one of the news agencies, categorized it as a private equity deal, which it's not. It's a private credit deal. So private credit is like going to your normal bank.
Right.
It's a banking relationship. So the funds that we got, it's not incremental debt. we had, as an accounting firm, we had a pension plan, a deferred compensation plan for when partners left. The creation of the ESOP, bringing in the money that came in, is in essence a refinance of our current line of credit plus our obligations to the partners for their pension that they now had to forego, plus the tax benefits. There's tremendous tax benefits being an ESOP. Those three add up to the total amount of debt that was taken on. But you got to remember the debt that was taken on, you've got to wipe out a similar amount as well of other liabilities. So it's almost like a wash, but the benefit of doing it this way is versus, let's say, private equity who's coming into our space at the moment and buying some firms. The benefit here is this allows BDO to maintain ownership of the firm, and we control our future versus a private equity group controlling our future. So this really helps everyone. Our partners still get their pensions. They're basically getting it up front versus the long term. And there's certain vesting that we've got to deal with. But in essence, they're getting it up front. And we had to pay off the other debt that we had. So it comes out equal.
So to simplify this for our listeners and myself, tell me if I've got this right. So BDO is no longer a partnership. It's now a corporation. And
Yes.
the partners are now shareholders.
That's correct. But we had done that before we became an ESOP.
Okay, so you did that. I assume that was in preparation for
No.
No, it wasn't. You just did that anyway. Okay.
We did that anyway for various tax reasons. So one of the reason for that was we and the two were pretty close together, so it does seem like we did it in preparation. It was just fortuitous that to become an ESOP, you needed to be a corporation, and we already had gone down that road. When I started as CEO in 2012, our DSO, our days sales outstanding, was about 100 days, which is really poor for a firm like ours. So one of the things that we've been striving for over the last decade was to bring that number down. Today, that number's around 30 days, which means we're getting collections coming into the firm quicker. As I told you, we grew from 600 to 3 billion.
5 times
we're
growth.
5 times bigger, and we are collecting 3 times quicker. All of that added together equals one big tax problem. And we were a cash basis taxpayer as a partnership. And you got your accrual financial statements based on how we reward everyone, our bonus plans, everything else. But we were having to pay cash on the collections, which were coming in so quickly that we needed to take advantage of being a corporation. And the most recent tax changes that came into effect in the previous administration. So we took advantage of that to sort of right size it and create something for our partners where there's some predictability about what it is they're going to pay in terms of tax, not the volatility. And we also have some very large Florida practices, Tennessee, Washington State, Texas, Nevada, all areas where they don't have state income taxes. So there's a lot of benefit for all of those. So we moved to becoming a corporation, and then as we continued working through everything, the ESOP came up, and sometimes you're better off being lucky than good, right? And in the right place. So that's why two separate things.
So we've been talking now so far about the benefits to the partners, tax benefits of becoming a corporation, certainly benefits in accelerating their pension payouts in the form of this conversion to an ESOP. Let's talk about the staff now. Pretend that David and I are fresh graduates. We just got our accounting degrees. We've been recruited to BDO. We're excited to start. And we are learning about this ESOP thing, which we've never heard about. We have no idea. How would you describe it to us? How's it going to impact us in our first year?
So let's just say David's going to firm A and you're going to firm B. Both of you are going to get a salary, call it $60,000, $70,000, let's say. Both of you are going to get similar benefits. Both of you will get a bonus at the end of the year for maybe call it $5,000, just to throw out some round numbers. So at the end of the day, you're going to get $75,000 each plus all your benefits. But then Blake says to David, the firm I'm going to is BDO, and they have an ESOP. And you know what happens there? At BDO, they give an allocation on an annual basis of 10% of my compensation. So that's $75,000. I'm going to get an additional $7,500 for free. They're not taking anything away. It's exactly on top of everything. So, David, next time we go out, I'll buy you lunch because you chose the wrong firm. So what happens is, in 1974, the Employee Retirement Income Security Act was issued, ERISA, and it basically was the start of ESOPs. And what it says is these allocations, you get an allocation account. So, Blake, you would have an allocation account at BDO. Doesn't take anything away from your salary or bonus or your 401k match.
This is all on top.
It's all on top.
Okay.
And you can pick a number that you want to contribute into this. We chose 10%. So you'll get $7,500 this year. In stock within the it's called an ESOP allocation account. It's not stock like you'd think you're buying 100 shares of Apple. It's the value of, you get dollars, and those dollars get calculated at the end of the year based on a valuation of the firm. So the firm equates, you value it out and you get the price per share within the firm. Each of the people within the allocation account has a certain amount of shares based on those dollars. So you take the value per share, put it into however many dollars in your allocation account, equates to a certain amount of shares. So it's called a beneficial interest in the earnings of the firm. It's not something like a pure interest that one would think, but it's the same for the partners. We're also dealing with a beneficial interest. So what happens is you get your $7,500, and the IRS caps the compensation at $330 to have some equality. I mean, the whole point of this act was to create an evenness, an equalization of wealth. And
could I ask you a question there? Is that 10% allocation, is that taxable to me?
When you take the money out.
Okay, but if I don't touch it, if I just leave it in there, keep my interest in BDO, I don't pay tax yet.
Yeah, it's like an IRA.
Okay.
And when we say when I take it out, is this like tied to, like, I can only access it at the end when I leave my return? Let's say Blake wants to, he works there 3 years, he wants to pull some money out to buy a house. Is there a marketplace? Like, is there a way for him to pull money out of the ESOP?
Yeah, that's a great question, because this is the beauty of the ESOP. Remember, I told you about the staff turnover in our profession, like when people come, people go. So the vesting for your 10% in year one, you vest over 6 years. After year one, you're at 0. After year 2, you're at 20%. Year 3 is 40, 60, 80. So when you hit the second year, But then let's just say you didn't get an increase and you're still at the same number. So now you'd have 15,000 in your account, but you're only 20% vested. So if you decide to leave, you get a check from BDO for $3,000. And this is the beauty of an ESOP. That 12,000 of yours goes to everyone else in the firm. It's spread out across the firm. So all the people, whenever someone leaves, you just became richer.
If somebody doesn't stay for 6 years.
If they don't stay for 6 years, that's what happens. So,
which is good for everyone else in the firm who does stay, because we want colleagues who stick around.
Yeah. Or evil colleagues that really try to burn people through.
Yeah.
But then you see, like David was saying, if you want to buy a house after 3 years, so after 3 years, you'd be 40% vested. All that happens is you go through your normal business of saying, I'm going to resign. And you'd say when you're going to leave. The firm has, I believe we pay out at the end of the year, we value the firm. And then anyone that leaves gets paid soon after that in terms of whatever their number is.
So Blake would have to leave the firm to get a withdrawal?
I thought you said he wanted to leave and build a house.
Oh, no, like he just wants to buy a house. Like, can he still be employed and still get some money?
All right. Okay, sorry. I thought you were talking about leaving. No, he doesn't have to leave, but you can take loans against your account, but you're not able to, it's not something that's tradable. You can't say, I'm going to cash in on this.
Got it. But I could take a loan against my ESOP the way I could take a loan against like a life insurance.
Or 401k.
Or 401k. Yeah. Okay. Got it. All right. And
so it actually works. I mean, it works really, really well. But why it's so well liked is by the companies like by a BDO is the tax benefits of an ESOP are huge. So when we start paying back this debt, the principal and the interest is tax deductible in full. Almost in full. I mean, there's a little bit that's not. When we make a distribution into all of our ESOP allocation accounts, that is also tax deductible. So what happens is, at the end of the day, the likelihood of a company that's an ESOP paying tax at the company level is pretty remote. I mean, the individuals will pay in their own right, but not the company.
Now, going back to this example, I'm making $75,000 at BDO. I get $7,500 in my ESOP allocation account after year one.
Yes.
Let's say 6 years later, I'm fully vested, and the firm has, let's just say, doubled in size. Is that money now worth twice as much? Do I now have $15,000 from year one?
Well, you're going to get that 10% in all 6 years. Yeah. So you're going to get each of those 6 years at 10%. So let's just say you stayed at the same salary and you got 7.5 each year for the 6 years. So you're around like 45,000. And now we value it and it's doubled. Yeah, then it's worth 90,000. And then you decide to leave, you get 90,000. But all of this in a typical environment, think about it. When people leave, what are you getting from the company when you leave? You can get your 401k to roll over into something else.
Yeah, now, maybe get some PTO.
Yeah, that's it.
Yeah.
So, and we still have that.
Oh, you still have the PTO accrual, so I still get that too. All right.
Yeah.
Yeah. I mean, I could see, like, I'm just putting myself into the shoes of a young accountant. I could see, hey, and I've got an incentive here now to stick around for at least 6 years instead of jumping out after 2 or 3.
So typically what happens in our profession is you got 2 really touch points where it's really a flashpoint in terms of leaving. It's about 2 to 3 years.
Yeah.
Because people have done it for a few years and they say, well, I'm not sure I want to do this. This is not so interesting. I want to try something else. And then it's at about 5-6 years when maybe some people have started a family and they're looking for different a different schedule that they want to work, and they leave then. And normally at that stage, they're leaving the profession. Now, after 5-6 years, you may think twice about it, because in year 7, when you get that 10%, it's 100% vested from year 7 onwards. So you don't have to wait 6 years for that.
That's great.
So all of a sudden, 1 year later, you got another 7,500. So it adds up, especially if the firm's winning. And so what happens is, based on all the research we've done on ESOPs, is that the three of us would say, why do we need to have that conference in Vegas or somewhere else where it's going to cost us a lot of money? Why don't we just save the money, and do it remote or virtual and everything else? They start thinking with an owner's mentality.
Right.
So
because I'm benefiting in the growth of the firm.
Yeah.
The money, the profits of the firm go into that.
Right. Because you were working it out on EBITDA. So they're looking at the earnings before interest, tax, depreciation, and amortization. That's the key metric. What is your EBITDA? That's the number that we're working towards. So trying to be the most profitable, that's how we're going to value the firm.
You're saying that EBITDA is how we calculate the firm valuation at the end of the year?
Yeah, that's one of the components. Yeah. And we have we work with an independent trustee, because we have to have independence in working with the firm to make it's got to be legit. So we do that, and they engage a firm to do a valuation. It's not BDO doing the valuation; it's them doing the valuation, and that's how you come up with the numbers on an annual basis.
So Blake is working his way up, but he has vested interest along the way. It keeps him engaged. He's loyal to BDO. He's solving shared vision, shared goals. I, in the meantime, at the other firm, hoping maybe if I stay there long enough, I might be able to become a partner or cash in one day. But there's nothing in between.
Right. That's pretty much how we had it. Was you put in your time to become a partner, and down the road, maybe 10, 12 years later, you'll become a partner. With us, we still have a partner level. Our shareholders, our principals, there's still that level, but from year 1, you really are an owner of sorts already. So even though you may not be at the partner level, the highest level where you are, signing audit reports or tax returns and so on, you still are earning something. You're getting a share in the profits of the firm. So, David, in your situation, you're putting your time in, you're investing, and what would happen at the end, let's say you make partner at that firm after 12 years, they'll say, okay, we're going to give you X% interest in the firm, and it's going to cost you $500,000 to buy into the firm. In our situation, there's no buy-in. You're in from day one. Everyone's in. And it's just the classification of what level you're working at that you move to over time. You put your time in, you move to the next level, put more time in, go to the next level, and ultimately you're at the partner level, but you're still not having to put any money in because you're an owner yourself.
So okay, help me understand this better. So I'm a manager, senior manager, or director, right? And then I'm voted in. Like, how do I become a partner at BDO? How is it different than Firm A?
Okay, so how you become a partner without the economics is exactly the same. You would have to be recommended to management that you need to be a partner. Every year we make partners. We just announced our class. We became an ESOP at the end of August, and January 1, we have a class of 70 new partners. they don't have to pay in, whereas a David's firm that have to pay in something. In our situation, they wouldn't pay in. So what would happen is you get certain options. So it's like a public company where there's options based on the value of the shares. So now you've got your salary, you've got your bonus, you've got your 401k. This is Blake, not you yet, David. And
I'm trying
Sorry,
to
David.
scrounge out the $500,000 to
I'm still buying you drinks.
yes.
and then you've got an ESOP allocation account of X. Now we throw in the options on top of this and say, okay, you're going to become a partner and we're going to give you a few hundred options, whatever number, however we work it out. Those options are like additional shares and get valued on an annual basis as well. So now you have an even further incentive to stay at the firm so you can cash in your options. And that's when you go out for drinks with David and you say to David, look, you're just being clueless. You need to give me your resume and I'll speak to someone at BDO and we'll get you in here. And you can also share in this.
And so when I'm a partner now, I have options that I take it I can purchase those options at the latest valued price.
Yeah. So what happens is the options would be there's a strike price for the options, and then they get valued on an annual basis. And that's where you could cash in on some of those options before leaving. Not on the other stuff first, but the options you could.
And then when I leave, let's say as a partner, I decide I want to leave. In a lot of firms, I guess in the traditional model, if you leave before retirement, you lose a lot,
Yes.
right? You lose everything you've built up. But here, I could can I exercise my options?
Yes.
And then I get the equity I've built up and I can cash out?
I mean, but the options will have the same vesting period as like the allocation account. So let's just say you've stayed 5 years, 6 years. Yeah, then you get paid out
Got
upon
it.
leaving.
So maybe, I stay 12 years, I make partner, I stay 6 years, I vested, then I can leave and I can take everything with me, basically.
Correct.
Okay.
Yeah.
This
It's a
sounds
good
much
deal.
simpler. It sounds like a much better deal for me as an employee.
Yeah.
Well, think about it when you're trying to make partner. And what I've always said all along since I started as CEO was we're a firm of, today we're 12,000 people. But when I started as CEO, we were just under 3,000. But everyone has a job to do. Every person plays a role, whether you're an auditor, you're an advisory, you're an administrative person. Everyone has a role to play, and everyone should benefit as well, not just the partners. And this sees to it that people that contribute and spend their time at the firm get the benefit. Why should the three of us, because we're a partner and we spend 20 years, we can make a lot of money out of this when we leave, and someone who is on the administrative side, not going to reach the partner level, gets nothing when they leave.
Yeah.
Now they can get a lot of money as well.
Well, and it makes BDO competitive with technology companies. I got drawn away. I was a manager at a top 25 firm. I got pulled out of there by a tech company that offered me stock options.
Yeah.
So
Yeah.
if there had been an ESOP at this firm, I might have been encouraged to stay.
So what happens is, our profession is sometimes a bit slow on the uptake. So it takes a while for people to realize what the tech companies and everyone else were doing and why they were succeeding so much. And that's all we're trying to do. We're just trying to do the exact same to create opportunities for everyone. The only downside would be if we do not perform.
Right.
And
Because everybody, but I mean, that makes sense because the employees they now have an ownership stake in the
Correct.
company. So if the company doesn't do well, that value is going to decrease.
Absolutely.
But
And you
you'll be
can't,
attracting higher quality candidates. You'll be stealing them, from other firms, but just also other industries now. Like it really
yeah.
makes you more competitive as an employer across the board.
And also what happens because of the tremendous tax benefits that I spoke about earlier, that gives free cash flow in terms of reinvesting in quality, reinvesting in our firm, in our methodology, in the software around what we use to provide services to clients, making us state of the art in what we're doing because we have that additional benefit. Whereas in a partnership structure, we wouldn't have been able to do all of that because of the tax situation. So now we're able to do this in a lot easier way.
So if it's all right with you, Wayne, I'd like to go back to the very first question that David asked, which is the why do this now? And to summarize, it sounds like the reason is because we have this talent crisis in our profession. You've got to decrease turnover. You've got to attract people into BDO. That's a big reason to do this. Let's talk about that talent crisis. We talk a lot on our show about the 150-hour rule to become a CPA. We talk a lot about the cost of that additional year of education. What are your thoughts on this? What do you think that we should be doing as a profession to address the gap when it comes specifically to the education requirements?
It is a tough situation. I think it's really, you got to look at the CPA as it's long been a gold standard. You have a CPA, it means something. It says you've gone through a certain level of education, which is why they put in the 150 hours in the first place. It's a demanding exam. Not a lot of people pass the exam, so it's an exclusive club that gets through. So, looking at it now, I would say I would not have gone for this 150-hour plan. But now that we're in this plan, it's not that easy to get out of the plan. So I think, like we're seeing a lot of states that are suing and trying to get out of this. But there are a lot of benefits as well of what the CPA license gives you today in terms of mobility. So I'm sitting in Maryland and I've got a client in California. I can do that. Otherwise, I'd need a license in California. And this is right around. But looking at the dwindling pipeline, you got to look at the reasons why this is happening. And a lot of people are pointing to the cost of that extra fifth year. And that is the ultimate dilemma, because just like I told you earlier about us going to India and doing work in India, why would America want to ship people off to another country or employ people in another country versus employing people here? We all agree we should employ the people here, but they aren't here. There are not enough people. So you have no choice but to do this. I'm on the board of the Center for Audit Quality. The Center for Audit Quality, the CAQ, was formed back in 2002 at the time of the Sarbanes-Oxley Act. When Sarbanes-Oxley came out, that was with the Arthur Andersen crisis, Enron, and so on. And the CAQ has a board that's made up of the 8 CEOs from the 8 national firms, the CEO of the AICPA, and 3 public interest board members, one of whom now is the former SEC chair, Mary Shapiro. So we're a board of 12, and we look at this. How do we improve the profession? How do we change the disparity that exists in wealth? And that's what the ESOP gets to as well, is creating something to help us equalize the wealth creation. That disparity, the CAQ found, exists in many of the less fortunate students, the undergrad students that cannot afford to do that fifth year today. So they have to then leave and they don't become a CPA. So they opt out. The CAQ is looking to design programs and get to work with other organizations to help create opportunities. Maybe it's an internship, maybe it's some other training that you can do while studying. You can start working at a CPA firm already and then get credit for whatever time you do that fifth year. So instead of staying on campus for a fifth year, spending all that money, maybe you can do something else. That is something that is being looked at the moment. There are lots of opportunities there that you can look at. And I think we will see more people. But I think when you come back to the less fortunate demographics, it's something that we have to look at and address as a way to alter that. And if you look at the HBCUs, the historically Black colleges and universities, there are about 125 in America, and not many of them have business schools. So it also creates a bit of a problem in trying to do that. But the CAQ is encouraging the firms, the members of the CAQ are the firms, and what they're doing is encouraging the firms to go talk at these universities, go talk at high schools. Because really at high school is where it all starts, and try and work with someone, mentor someone, be a role model for someone, help them, whether it's study groups for the CPA exam prep. A lot of the firms do this. They put groups together. But you got to find those population groups that are not getting into public accounting and then say why. So, the Black population only accounts for,
It's like 1% of CPAs.
yeah. And
it's way under.
Yeah, because they never had role models. Their parents weren't CPAs. They didn't see their parents doing something like that. And that's something we have to step back, take note of, and work with them in order to give them opportunities as well.
So setting aside mobility, let's say that we could solve the mobility issues. Would you
Yeah.
support a pathway that allows for 120 semester hours and 2 years of experience?
Yeah, I think that's something that could be done if you're able to do it, but you have the people that are in now that crisis. I think you are going to have to step back again to go forward, and that's what a lot of the firms are saying. That's what they want to do. They want to be able to go back. I don't think it's all bad, the 150, but if we take your argument and mobility is going to be okay everywhere.
Yeah, let's just say national
yeah.
leadership gets together, AICPA and NASBA come up with a plan to solve mobility, and all the states agree.
Yeah.
I know it sounds like a lot of work, but we've seen a lot of movement on the CPA exam window very quickly, going from 18 months to 30 months. If they can do that at the national level, then like nurses, for instance, during COVID, the nursing profession very quickly and rapidly adapted by states passing laws to allow nurses with licenses in other states to practice across borders very easily. And now nursing mobility is like really good. It's national.
And I think that's something that could easily be addressed. Now, I came from South Africa 35 years ago to America. In South Africa, to become a chartered accountant, so when I came here, there was no reciprocity. So I had to take a CPA exam all over again. But in order to become a chartered accountant, you have to do 3 years of practical work at a CPA firm. That's what I would like to see with the CPA exam, is do the practical work. So if you had to do 4 years, you do your 4-year degree, and then you go work at a firm for, even if it's 1 year and that's your fifth year, that should be sufficient in my mind.
Yeah, it makes sense to me. Every CPA I talk to, I ask this question. I say, what's more valuable in your mind, an extra year of education or an extra year of work experience?
There you go.
And
That's
it's the
so
work experience, right?
I could easily support that, and I've argued that already. I think it makes you a better accountant as well.
Yeah. My feeling about the education is just that it's so theoretical and hardly practical at all. Most of what I learned that I use day to
Yeah,
day, I learned on the job. I didn't learn it in school. I'm not
correct.
saying the theory isn't important, but I barely remember what I learned in advanced accounting, honestly. It's so hard to remember any of that when you don't do it.
I'm with you. Even when you do it, it's not that easy.
No.
It's
I'm don't ever put me in charge of a consolidation, Wayne. I don't think my education prepared me for
but
that.
that's the thing that the CPA exam and the ARCPA has done a good job of with NASBA changing the direction of the CPA exam. So let's say you don't want to do auditing, you don't want to do tax, but you want to deal with data analytics. You want to get into something more like AI or something along those lines. They've changed the exam where now you still have to do certain parts of it, but you don't have to study like government accounting, where do fund accounting. If you're not going to go into that field, why should you have to study that? And now you can study something like that, and that has created a lot of people coming in who are CPAs now who can't do auditing, they can't do tax, but they can do analytics, and that's
Yep.
I think will create some more excitement in the profession. And once we got that excitement, more people are going to follow and get into that as well.
Well, David, do you have any more questions for Wayne before we let him
No, I
go?
was just gonna thank him for coming on. I feel like, there's a brewery here I go to in Tucson, and it's employee owned, and the cans say, like, employee owned on the cans, and I'm just thinking like that if I go into a Publix, I'm always now from this point forward being like, "This is just like BDO. This
There
is how
you go.
BDO runs." The employee owned, like, this stamp you're gonna be able to put across every financial
Yeah.
statement. It's gonna be a very interesting story to watch, and congratulations, because I think most people think this is just for smaller companies, and arguably, when I was researching and preparing for this, I discovered lots of firms that offer ESOP services to clients,
Yeah.
but they don't actually do it for their own firm. So it's congratulations, I guess, on the courage to even do this.
Thank you. Thank you.
Actually, maybe we could end with that question, which is, do you have any advice for firms that are thinking about doing an ESOP, Wayne? Like, what would you tell me if I'm a firm owner thinking about doing this?
So I've gotten so many calls from firm leaders, firms smaller than us, and even some that are bigger than us, and they're not a lot bigger, asking how we did it. How did we go about it? It's fascinating. And one CEO told me that he actually spoke to his executive team and he was really upset about it. Why didn't you tell me? And now I've got to have one of our competitors showing us up. Um, I would say think outside of the box. And it's almost like Einstein's definition of insanity, trying to do the same thing over and over again, right? And that's what a lot of the firms, including BDO, was doing. And why didn't it work? And actually looking in the mirror and saying, okay, maybe there is a different way to go about it. I would tell a firm that, and I believe firmly, we will see some ESOPs probably before the end of the year or soon thereafter. And then I think it'll start mushrooming because at the end of the day, an ESOP can get you what private equity can get you, and you keep your firm.
Yeah, you don't give
So,
up that control.
yeah, I would say to someone, model it out. And we'd be happy to talk to anyone that needs help with this. Is just work through it, model it out, see where you could be in 20, 30, 40, 50 years in your projections for your firm, and see if it's profitable, see if it makes sense. Then you speak to a bank, and then you start going down that road, and you get some strategic advisor to help you along the way. But I think it's being able to think differently and that'll help you attract people as well.
Wayne, thank you so much for your time. David and I have been talking with Wayne Berson, CEO of BDO USA. Really eager to follow BDO in the years to come. And if you just do another 5x on growth in another 10 years, it's going to be a totally different profession. We might have to, it's not going to be the big four anymore. So yeah, that'll be exciting. I'll feel like an old man then when it's no longer, like that, when that change happens, I feel like a generational change.
Me too.
It's no longer the big five or big six. Now maybe we can make it go back up. We can increase that number again. All right. Thanks. Thank you. Talk to you soon.
Thanks for having me.
Thanks for listening. I hope you enjoyed this episode and that you learned something new. And if you did, wouldn't it be nice to get some CPE credit for it? Well, I've got great news. My new app, Earmark CPE, offers free NASBA-approved CPE credits for listening to podcasts, including this one. Visit earmarkcpe.com to download the app, take a short quiz, and get your CPE certificate. That's earmarkcpe.com.